Welcome back. Simon Conn is a senior portfolio manager at Anton Taliaferro's Investor Mutual, and one of his briefs is to be across the small cap companies that have potential. And it comes at a time when I think playing small caps is sensible at this stage of the market cycle. Simon, thanks for joining us.
Thanks, Peter.
Do you think I'm right in suggesting, because the small caps were left behind for a long time, and I figure as the dollar comes down, some small caps are going to do well over the next year or two?
Yeah, look, particularly if you think about the concentration in Australia. I mean, there's a heavy weighting in Australia towards the banks and resource stocks.
Yeah.
And, the resource stocks are, pressured by falling commodity prices. Nothing ends a commodities boom like a commodity boom, and we get massive oversupply just at the time that demand's slowing.
Yep.
And then the banks, that looks quite, benign credit growth, and so a low growth environment, and also struggling with extra, capital they might have to carry.
Yeah.
So I think, looking beyond the top 20 is a good place to look at the moment, and then, that's where we're finding more value in a market that looks pretty difficult.
Yeah, I noticed Charlie Aiken wrote a piece for my Switzer Super Report, which will be out tomorrow. But he made the point that BHP is becoming a smaller part of the market. It's only about 6.7% of market cap, which is a bit of a change, isn't it?
Yeah, it is. I mean, the market's dynamic, and it reflects that. I mean, in our own index, in the small cap index, at one stage we had small cap miners and mining contractors at almost 50% of the index.
Yeah.
And they're now down to about 25%. So there's been a massive contraction in that sector.
Yeah. I know Anton likes doing the big stuff and gambling on companies like Telstra and then getting it right. But
I wouldn't call it gambling, Peter, but anyway.
No, but when he hung in there for a long time, it looked like gambling, but really paid off when it came good.
Yep.
And of course, he would pick me up on the word gambling as well. So you're well trained by Anton.
Okay.
But you do look at the small caps.
Yes.
And so what are you looking for? Obviously, the mining services, you have to be a long-term contrarian waiting for those
absolutely.
guys.
Like the mining contractors just don't
Too
stack
hard.
up. Yeah. And look, the approach we've applied for 17, going on 18 years is the same for large caps and small caps. So, looking for those businesses that have got strong competitive advantage, businesses that have got recurring income streams, so we avoid property developers and the contractors, businesses that have got really good management, and we spend a lot of time talking to management and assessing their growth opportunities and how they're investing the money, trading at a reasonable price that can grow. And obviously, price is the hard piece of the puzzle at the moment when valuations are full. But
okay. Now, you guys recently listed a listed investment company, QVE.
That's correct.
What is the strategy in that particular investment vehicle?
Well, the strategy is to focus on looking for the same attributes in the X20 sector of the market.
Outside the top 20.
So we're going outside the top 20. And
how low do you go?
Our minimum market cap of $200 million.
Okay.
So it's a fairly broad range. So from stock number 21 down to minimum market.
And how many stocks do you hold in the fund?
It's about 35 at the current time.
Okay. Why do you select 35? Does it reduce your exposure to any dumb CEO?
We're targeting sort of between 40 and 50.
Yeah.
So we've still got about 30% cash, and so we're still looking to average into positions. But obviously valuations aren't as cheap as they were. So obviously a bigger weight will if it's cheaper or more upside in the stock.
Yeah.
So.
I noticed that Michael Knox on my show on Monday had a fair market valuation of around 6.2, but he's adjusted back to 5.8. For a number of reasons. Earnings don't look as strong and interest rates didn't get cut. Are you of the same kind of feeling as that?
Look, I think the market's had a good run. We just need to see some sort of pullback, and I'm sure we know we go through periods. You've been around long enough, I've seen it enough. We'll go through periods of volatility where we'll see a pullback, and today we saw a bit of a pullback, particularly in those sectors that have been in favour of the banks, particularly.
Yeah.
So,
okay. Is it a lot for you to hold 30%? Of cash?
We said initially we'd target maximum 25% cash.
Yeah.
We've given ourselves another 6 months from the initial listing period to waiting for opportunities to arise, and we didn't want to drive into prices just because stocks to get invested. We want to give ourselves time to prudently buy and at the right price, because two ways you lose money in the market are buying crappy stocks and paying too much for things. And we've really focused on buying companies at the right price.
Okay, so are there some companies at the moment you like, and you tell us why?
Yeah, sure. Look, one of the stocks that we've been buying recently, and it's publicly disclosed, is GWA, and it's a business I've followed for 17 years. We've owned it before. We sold it out of the portfolio some time ago, and we've just reinitiated.
For my viewers who don't know GWA, what business?
It's not a household name in terms of the company,
right,
but the brands are fantastic. They have Caroma, which is Australia's leading toilet or vitreous china brand.
Yeah.
So they've got a high market share, let's say 60, 70%, and that underpins a high level of cash flow to reinvest in the business. So they're a clear market leader in dual flush toilets. So we live on the dry continent of the earth, and these guys invented push-button dual flush toilets.
Even the Americans will admit that. But what's interesting is that I guess you've also linked it to the fact that the outlook for home building is very good, isn't it?
That's right. And this is a late stage beneficiary of that. So as starts lead to completions, we'll see one of the last things is the bathroom to go in, and that will lead to increased demand for their product.
But I guess, does it mean that you have to be on the lookout for when the building cycle is starting to turn and as a consequence get out at the right time?
Look, that's obviously, it's a function of valuation and what's in the price. I mean, at the moment, it's not in the price. 15 times with almost a, very, very lightly geared balance sheet after some asset sales. It's not priced for any of the upside.
And clearly you like the management because it's a critically important issue.
Yeah, look, I think, Peter Crowley and the management team have had us a bit of a diversification strategy, and I think the reason we're quite interested in the business now is that we've exited those non-core businesses, and like a lot of companies, they've outsourced manufacturing to Asia. So we'll see less capital employed in the business, and actually should be able to free them up in terms of free cash flow generation, and hopefully will lead to an increased dividend. And this year, no dividend, but we're looking for next year to return to dividend.
Okay, what else, Simon?
Look, another business we've done well out of over the last 12 months is a company called Tox-Free Solutions.
Tox-Free Solutions?
It's not a household name.
No, it's not. What's the tick?
But industrial waste is ubiquitous, and there's a strong underlying trend to treat waste in thoughtful ways. So in the old days, 20, 30 years ago, when you and I were growing up, everything just went in a landfill site. And now
what was wrong with that?
Well,
yeah, we know, but at the time we didn't think.
But companies, governments and consumers, corporates, we're all trying to be more environmentally friendly. Landfills are filling up and becoming more expensive. And so what we're seeing is a trend to all of this waste being treated at high-end waste disposal sites. And this company called Tox-Free, or TOX is the code, has a lot of these licensed facilities. And that underpins a very recurring, good cash flow business, recurring earnings business. It's well managed, it's grown regularly through small acquisitions. They made an acquisition, a company called Wanless in Queensland some time ago, and that all brings more waste through the business. And the ongoing activity in mining and industrial activity leads to ongoing waste. They're actually going to benefit from an infrastructure spend, believe it or not, so a lot of dirt has to be pulled up. Bridges and whatnot has to be...
So the budget ultimately could be good for the company.
Exactly right. So this could be a beneficiary of that. So, they're one of those ways that we think they can grow.
Now, this is my final question. Clearly you are a bottom-up kind of analyst.
Yes.
But I guess you do respect the macro outlook, and at the moment it looks pretty subdued. We know the Reserve Bank's probably going to cut again, and the government's sort of suggesting that they're going to have a much more positive approach to growth. In fact, the Prime Minister mentioned jobs and growth today. Now, if the economy starts picking up in the second half, rolling into the first half of next year, are there a lot of companies in your portfolio that will be natural beneficiaries of a stronger economy?
Look, I think, our outlook is that it's a low-growth environment, Peter. I'm not saying that there's going to be a huge cyclical pickup in the economy. Obviously, housing is one sector that I think can do well, and that's why we've positioned in GWA. But I think it's going to be it's a slow-growth environment. So what we've positioned is in businesses that can do well in that environment. So we're looking at companies that have taken costs out of their business, or companies that are making acquisitions. So a company we own is Pact Group, based in Melbourne, founded by Rafi Gamenda. It's grown regularly through small bolt-on acquisitions. Strong market position in rigid plastics in Australia. They're the clear market leader. There's a trend to rigid plastics away from tin and other products. And he's been able to grow gradually through acquisitions. So if he can use his cash flow to bolt on small acquisitions, take costs out of his business, as he's just announced, I think that's one way you can make money in the market.
Do you get fascinated when you go inside these businesses and you just start discovering how outside the square the thinking the entrepreneur is, but how wise they are in the way that they actually see opportunities and make them happen? Yeah,
look, I think that's the best part about my job, getting to talk to management of the companies and meeting, the entrepreneurs of Australia, the people that generate, wealth and create jobs for the country. And, there's a really vibrant entrepreneurial class in Australia. And I think that's what the market's there for, isn't it, Peter?
Without a doubt.
To fund their growth.
And some people think fund managers don't have a good time. Simon, thanks for joining us.
Thanks very much, Peter.